Hello, and thank you for joining us on Technical Roundup. We have another episode as part of our kind of podcasty interview to be defined type of series. We are speaking today to Eric Wall, who's kindly offered his time, not sure about guarantees, offered his time to talk to us on a broad range of topics. We look forward to picking his mind. Before we get started, of course, a quick thank you to Blockfolio, the sponsor of Technical Roundup. Make sure to visit blockfolio.com or blockfolio.trade for further information. So joining me, of course, is Donald and then Eric himself. Gentlemen, how's everyone doing?
Yeah, hey guys, thanks for having me on. It's been quite interesting. I mean, I think that we have circled each other for a long time on Twitter, and it didn't start out that nicely in the beginning, which sort of clashed immediately, and then each of us have persisted in the space. I think we've circled around each other for about 4 years now, and we've come to learn that all of us here on this podcast has a genuine interest in the deeper topics in the space. And I think that once we just observed each other for a long enough time, we understood that there is no reason to dislike each other. So we sort of have apologized to each other, and now we're friends. That's nice.
It wouldn't be Twitter without a fight, isn't that right, Donald?
Yeah. I mean, over 4 years, a lot of stuff happens, right? And I'm more than happy to have bygones be bygones.
Yeah, for sure. I very much agree. Eric is the Chief Investment Officer at Arcane Assets, if his LinkedIn is to be believed, which of course I do. I'm sure you've been on a few of these. In fact, I know you have because I've listened to some of them, Eric. And, you know, there's always the introductory section to these, like, who are you? How did you get into Bitcoin, etc. As our audience will be acutely aware, we like to almost sidestep that to some extent or approach it from a slightly different angle. So when I first heard of you, or when my first memory, if you will, on Twitter is completely nuking via long threads how certain altcoins were built up, right? Whether it was Neo, IOTA, I'm sure there are some others come to mind. Those kind of legendary and at that point viral threads is really where my kind of first impulse association with Eric Wall comes from. Do you want to give us some maybe background, or does that bring back any memories?
Yeah, and I'm glad that there are some people who don't just know me as the rainbow guy, and there are some people that remembers my history. I was actually not that visible in the cryptocurrency community at all until I wrote those threads. That's sort of when I logged on to Twitter and created a Medium page for the first time was when I was doing my due diligence on the IOTA project and the Eternity project. And I had a lot to say about both those projects, and I didn't see that there was any information. The stuff that I had read, the stuff that I had discovered, I didn't see that there were any of that information that the public was aware about. So it was completely a frustration on my end that the discussions that I saw online weren't going in the direction that I thought they should be going. So I took it upon myself, well, okay, if nobody else is talking about this, then I got to get this message out. And one of those things was that the entire IOTA system was operated by a single centralized entity that could shut the entire system down. And I mean, they got listed on Bitfinex in June 2017, and Bitfinex quoted their advantages, that they were endlessly scalable and completely decentralized and zero fees and all these amazing advantages. And I didn't see anywhere that anybody was talking about how nascent and untested and actually fundamentally incapable that technology was at actually delivering on those promises. So I started writing about the Eternity project, which I had discovered in my due diligence. I actually started to email the developers of the system, and they had just conducted, I think, a $42 million raise through an ICO. So I started to write about that project, and then IOTA sort of came from the side and distracted me so much that I ended up that the first piece that I wrote was about the IOTA project. And in the beginning, I had zero audience. I couldn't get the message out. So what I did was I knew of 2 people that would resonate with the message. So I contacted Tonebase and Krista Rose, and I wrote them a personal email, and I said, I'm aware about who you are in this space, and I think that this article may be of relevance to the listeners of your audience. And I asked them just kindly, could you just reshare this article that I've written? That's the only time that I've done that. And both Krista Rose and Tonebase reshared the article. And from those 2 accounts, then my Twitter account got visibility and my writings got visibility. So when I meet Tonebase at conferences, he's like, "Hey man, I made you," because he was the first like interaction that I got on Twitter. So I think that that sort of put me on the map as they used to call me the altcoin slayer, because I think that a lot of Bitcoiners had this frustration that they had done their due diligence on the market and they had most of their assets invested in Bitcoin. And then when their friends came into the space in 2017, their friends would buy these rubbish coins that they'd never heard about. So it was very convenient for them that there was these Twitter threads and articles that they could link to that basically took those projects out the back and shot them in the head, which was what I did in my threads. So that positioned me as the altcoin slayer for a while. And if I was intelligent and if I was strategic with my identity in the space, I probably should have stuck to just doing that. But however, what happened was that, I have my own intellectual, like I am just like in this space, some guy that is trying to figure it all out, like where is the innovation going, what new projects are of interest. So I couldn't stick to this one trick that I knew would have made me liked by everyone if I just kept doing that trick. So nowadays I'm more like a controversial figure in the Bitcoin space, because I think at the end of 2018, 2019, when all the altcoins were dead, there were no more altcoins to slay, then I sort of turned my weapons back against the Bitcoin community. And I saw that there were many people in the Bitcoin community that had gotten too self-confident and too sure that what they were doing were the smartest things and that they had the greatest minds and the best people. So I took it upon myself to be like a balancing act, like wherever I would see that there would be overhyped, that something was overhyped in the market, then I would try to just be the counter narrative to that. And that's not something that I do strategically. It's just that I'm like everyone else. I'm on crypto Twitter. I see things. I see that people talk about things, and I get frustrated when things are overhyped. And when things are underhyped, I like to, take that side of the story instead. So yeah, that's kind of who I am in the space, I suppose.
I love that. It kind of reminds me of what I came into the space for, just on the trading side, because I moved into the space because I saw so much shitty trading advice, and you did it on the fundamental side, which back then I enjoyed your IOTA and NEO articles a lot, because I hated those projects too, just based off of the fact that I've tried using them both and it didn't work. So I fondly remember that. Good times.
Well, before those times, I was actually so before I became interested in the technological stuff of the cryptocurrencies, like I have a computer science degree and I actually specialized in blockchain technology in 2015. It was a computer science degree, but I wrote my master thesis on blockchain, and I took the courses that would allow me to understand the cryptographic primitives that underbuild various blockchain protocols. But before that, like my initial interest in the cryptocurrency industry was also in trading. So I discovered Bitcoin in 2012, and I thought that, okay, so this is basically an entirely new market where this is somewhere where, I don't need to know all the lessons from the equities market. I don't need to know all the lessons from the bonds market, or just trading in general, this is a clean slate where I can, and I was, when I discovered Bitcoin, I was 21, I suppose. So I thought that this is a space where I can build an edge, where I'm one of the first to learn and study everything so that I can become an expert in this field. But I actually started out trying to understand how to trade Bitcoin. And for a number of years, I was actually doing technical analysis. So my journey into crypto wasn't that dissimilar from how I think that the average person's journey into crypto looks. I mean, most of the people, they get interested because they see cryptocurrencies and that there's money to be made, and then they want to understand how to trade those assets so that they can build their wealth. And I was no different. I was doing exactly that, and I fell headfirst into our Bitcoin markets, the subreddit Bitcoin markets. That's where I did my initial studies of how to trade Bitcoins. And I was just like everyone else. I started out with the basic technical indicators like the RSI, the MACD, and I was using those for a couple of years, and I was trying to build out my own trading style. It wasn't until a couple of years down the road where I learned sufficiently well how to program that I could test my own trading strategies, like back test my own strategies, and I could then apply a more scientific method to what I was actually doing, and investigate did my strategies actually have an edge in the market. And what I discovered after learning a bit of Python was that I had no edge in the market, and most of the trading decisions that I had made in the past, I mean, you have these technical parameters that you observe, and then you apply a nudge of subjectivity, like, okay, the RSI is looking good, the MACD is looking good, and there's also this news coming out about Bitcoin about, for instance, in 2015 when the Lightning Network paper was coming out. You could sort of see how from that the enthusiasm was building up in the space, that, oh, we're finally going to be able to do transactions instantly at no cost. And you could sort of see how that would be reflected in the price. And I later understood that the only reason that I was profitable was that I was weighing in these other things, these external things that happened outside of the price, and I embedded that understanding into my trading. And that's how I was actually, that's the only reason that I made any profit at all. So what I did was, as I got more experienced in trading, I unlearned everything that I had learned from our Bitcoin markets. And I now think that, people that start out and they think that they can trade Bitcoin profitably by just, using MACD, the 3-day MACD, or looking at the RSI, like, if you think that you're going to be profitable doing that, then, I've got a bridge to sell you. That's not how that's not how it works. So nowadays, like, I'm on Twitter and I deride all these people that use very naive technical analysis methods to trade Bitcoin. But to be completely transparent, I mean, I was exactly like those guys when I started out. So I think that the reason, there's this saying that we are very quick to see our own flaws in others. I mean, it's very easy to identify when someone's doing something wrong when you have done that mistake yourself. So one of the reasons that I take so much issue with the stock to flow model and other heavily technically oriented patterns of trading is that, I mean, I'm guilty myself of having committed to that type of thinking in the past myself. So I completely understand why people would think this way, and it's also why I can understand how many people also go wrong by giving these indicators undue relevance when they're making their trading decisions.
Oh, for sure.
I still remember that you were basically the only person that had the balls to stand up to the stock to flow guys back in the day. Like, I still remember, like, I was thinking it was so ridiculous what they were saying, but it was like not an argument worth having at the time on Twitter. And I still remember you charging straight into that. What made you kind of go at it that hard? Was it just a desire to kind of make things right, or what?
Yeah, I mean, so Plan B, he doesn't follow a lot of people on Twitter, but he follows me. I'm one of the few people that I think that he knew me, and he knew my ideas, and he probably had some respect for the viewpoints that I laid out from the past. So I thought that, okay, this guy listens to me, so maybe I can have an intelligent conversation with him around the arguments that he was making. And I think it just started with right off the bat when he described he has a description for why you cannot apply the stock to flow model to altcoins, but you can apply it to Bitcoin, and he calls that unforgeable costliness. That there's proof of work involved in producing Bitcoins, and because of that unforgeability, then Bitcoin trades differently than other assets. And that's sort of the first thing that I thought sounded strange. I mean, Bitcoin is heavily speculative. The other assets are also heavily speculative. I mean, either you make the argument that it is the supply dynamics that determine the price, or there's something else. Maybe it's the demand side that actually governs the price, which is what I think. So I just started out by, I wanted to put this unforgeable costliness idea to the test. So I started to ask him on Twitter, like, how does this, and I took other examples, and I said, okay, well, is it really a binary thing? Like, shouldn't we see a little bit of correlation between something that for example, Litecoin would have a little bit more correlation with its stock to flow than something that is for XRP, that is just thinly minted from thin air? Like, is it just a completely binary decision between Bitcoin and everything else? So I was trying to test him out on those points that he was making, and I thought that I thought that my arguments were stronger, but in the how the Twitter, just how the conversations went on Twitter, was that I basically got no visibility at all, trying to criticize the stock to flow model on its technical merits. And the only things that people were sharing were the very bullish price projections that the model was producing. And I did this for a year. I went very deep into the logic of the stock to flow model, and I've done a lot of writing about all the assumptions that the stock to flow model makes, and I've compared that to other models and other assumptions. And for instance, you can study the stock to flow ratio of gold, which should, there's the gold is as far as anything else, perhaps more than anything else, also has this property of unforgeable costliness, but you cannot see any correlation between the stock to flow variations in gold and the price of gold. You can identify that gold is highly valued because the stock to flow ratio is high, but you cannot immediately from the small variations. And now with Bitcoin, with these halvings, the variations are very small still compared to what's happening on the demand side. So I thought that I would have some ability to sort of convince Plan B about the flaws of the model. But in the end, I was completely unsuccessful at doing that, and it just built this immense frustration on my end. And it also built some frustrations with some other guys, like Nick Carter and Hasu. They are actually people that are cited in a lot of Plan B's work. For instance, his new model, the stock to flow cross asset model, heavily leans on the work by Nick and Hasu, where they describe different visions, different epochs of Bitcoin in its history. But they are, Hasu and Nick, they are also heavy critics of the stock to flow model. And what happened was that when we saw that so much of the Bitcoin ecosystem just piled into this, piled on and just went with the stock to flow model, it sort of separated. I think it was a very clear separation in the Bitcoin Twitter ecosystem, where who were the people that really had a scientific, that had a stronger preference for the truth, and who were the ones that favored positive price charts over anything else. So before the stock to flow model came, there was a lot. We were all of us Bitcoiners. We were a big group of friends, and then the stock to flow model made it very obvious to me that who was willing to go against something even though that it was extremely positive for Bitcoin. Like the stock to flow model says that the price is going to go up and be 200, 300,000 of dollars, but it doesn't rest on a sound basis. So, I mean, you have to kind of go against Bitcoin's own narratives to become a critic of the stock to flow model, and that separates you from a lot of the other Bitcoiners. So I think me, Hasu, and Nick, we're very good friends now because we picked the same side in that sort of debate. And I think in retrospect, I'm kind of happy that the whole debate happened, because it taught me so much about some people that I previously thought had that they were on the right side or on the side of reason, the side of science, that I discovered in the end were only there for the memes and the number go up theories, and not so much for the science.
For those who, just taking us a step back very briefly, for those who might not be aware of, I mean, almost certainly they've heard of it, right? It became so popular, as you mentioned. And this is maybe my own cynical view, but I tend to agree with you that it's because of the price projections that it offers. That's probably about as far as maybe 99% of people go when it comes to studying, if I can even use that verb, stock to flow. For example...
Oh, no. It's definitely not just about the price. It's also about the colors. The colors in the chart are extremely important, and that's I think that I've proven that empirically with the rainbow chart, that you can make a model as popular as that stock to flow model if it has enough colors in it.
I'll bring up the rainbow chart momentarily, which is its own fascinating story. But for those who are unaware of like what the stock to flow model tries to show, what's your high level overview of those who've never really looked into how it's calculated and instead just look at the high price projections that it offers? What's the kind of elevator pitch of the model or the assumptions it's making?
Yeah, it's very simple. So Bitcoin started out by creating 50 Bitcoin in every block. And then after 4 years, it was 25 Bitcoin in every block. And then after another 4 years, it was 12.5. And the stock to flow model basically posits that you can see that the price has gone up throughout this time, that the number of Bitcoins that have been minted in relation to how many were existing previously, you can see that the price has gone up as the flow, which is exactly how many Bitcoins are getting minted in each block. You can see that the price has gone up while the flow in relation to the stock has gone down, which means that the stock to flow ratio has gone up. So while Bitcoin undergoes these halvings all the time, you can also see that the price is going up, and then you can sort of say, well, maybe there's a correlation here. We know that the stock to flow is going up, and we know that the price is going up, and then you can take that data and create a model out of it, and then you can say, okay, well, if there is a causal relationship here with the stock to flow going up, and if there is and with the price going up, if there's a relationship here, and if we mathematically model that, then if we just we know that there are going to be halvings in the future. So if we just forecast the future based on how we know that the emission rate is going to be in Bitcoin and the halvings, then we can say exactly what the price is going to be. So that's sort of what the model does, and it uses a regression analysis to create that model. So yeah, that's my high level pitch, I'd say.
So you mentioned one of the for those unaware, I don't know how up to date this is. Perhaps you can let us know. But there is also a Medium article titled "A List of the Greatest Blows to the Stock to Flow Model," right? Where you provide some background and then basically, essentially, a chronology as to how the model was developed and kind of amendments, criticisms, retractions, people changing their mind. But as you mentioned, you don't, that maybe hasn't had the type of impact that you thought it might have.
I think that one thing has changed a lot with the stock to flow model, which is the whole story about the co-integration. And that's something that I'm very happy that we were able to take out of the pitch for the stock to flow model. So the co-integration is a statistical test that you can apply where you have two data series, and you analyze those data series and you try to see, well, is one of these series impacting the other series? And the guy, Nick Emblow, who did these tests, he was when he applied this test, he was sure that he had detected. He was sure that he couldn't disprove that there was no cointegration, which is basically that's how you do statistical tests. You try to disprove theses, and he couldn't disprove that there wasn't a deep relationship between the two variables. So that means that meant that the Bitcoin price was co-integrated with the stock to flow, and that was something that everyone loved in the Bitcoin industry. Even some very influential people and very educated and smart people in the Bitcoin space, they started to parrot this idea of the co-integration property between Bitcoin and the stock to flow. So that made it once that test had been done, then and proven, then for a lot of people, the stock to flow model stopped being a theory. It was now science. It was a scientific fact. So I had to, that made it, and I think that's one of the reasons that the conversation got so frustrating, because people literally thought that this was a scientifically proven fact due to the co-integration tests. So it took how we were able to eventually turn this debate around was that we literally got the guy who wrote the co-integration mathematical, the co-integration tests that the Nick Emblo had used, the guy who wrote the code for that test. His name is Sebastian Kripfgans. He works at the University of Exeter, and he was pulled into the stock to flow debate, and he said, well, you have applied this test incorrectly. And he was then later brought into a conference that was called Value of Bitcoin, where he was tasked with the task of, from his point of view, is there co-integration between stock to flow and the Bitcoin price or not? And his conclusion was a resounding no, that there was no co-integration between the stock to flow model and the Bitcoin price. So it completely annihilated the theories that the Bitcoin space had been relying on in order to make the stock to flow model a scientific truth. And that's why Plan B, sort of immediately as this started to happen, Plan B pivoted to a different model. And that's the stock to the cross asset model that is inherently different from the stock to flow model, and it uses a different method to forecast the price, and it doesn't rely so heavily on co-integration. It relies on interpolation between other asset classes. You take the real estate and the other asset classes, and you sort of interpolate what the price of Bitcoin will be from that data. And so he was trying to escape this disproven co-integration idea and coming up with a new theory that he could onboard the belief, like everyone that loved the stock to flow model would get annihilated in the overall discussion around the model if that model didn't have the co-integration backing it. So they needed a new story for the model to live on, and that's what they've done now. And I was actually very surprised that he was able to, basically said, okay, everyone that's followed me for a year now, that have listened to me say 100 times that I will, the only thing that's going to make me change my mind about my forecast for the Bitcoin price is if the co-integration between Bitcoin and stock to flow breaks down. And then when that happened, he just switched to another model, and everyone just happily followed along for that. So that was very, very interesting and funny to see. And now I think that we have been able to change the narrative a little bit so that people understand that the stock to flow model is a theory, at least, and I don't have to face these people that say, well, the stock to flow model is a scientific fact, and if you don't think that, you don't understand math or statistics, which is what they previously said. So I think that the stock to flow cult has become a lot more bearable since we were able to make those statements around the scientific degree of the model detract.
Why do you think so many people latch onto these? Stock to flow, there's a bunch more. Even your rainbow chart. Why do you think everyone kind of loves to parade them all around?
Yeah, I think in order to answer that question, you need to think how a like a person that has no background in finance, that has no background in statistics, that doesn't know much about cryptocurrency, that just wants to make money. I mean, I remember when I was new in the cryptocurrency space and I was on the subreddit Bitcoin markets, and there was a guy there that used to produce these weekly charts, and that was actually where the rainbow model came from. His name was Aesop, and it wasn't it wasn't this the logarithmic regression, this curved rainbow that I published on my Twitter account. That was not the model that Aesop was showing. He had a completely straight rainbow, but that was the first time that I saw the rainbow colors in a price projection, but they were completely straight lines. And I remember when I was completely new to the concept of Bitcoin trading and this entire space, looking at the price bouncing around in this range, and you cannot sort of understand, okay, why is the price bouncing around this exact logarithmic range or this logarithmic projection? You don't understand that. You don't understand that the curve, the line that you see on the chart, has been produced retrospectively to fit the historic price. So this curve fit that the stock to flow model uses, and that the rainbow chart uses, and that a lot of other forecasts uses. I mean, you make this Plan B. He made this in 2019, or now with the cross asset model in 2020, I think. Those models are retroactively made to fit the price. So when you look at them today, you sort of see this model, and then you see, oh well, throughout history the price has followed that, like for some magical reason the price has tracked that trajectory. And you can see that with a rainbow chart as well, that it just magically follows along this beautiful trajectory. And you think, okay, well, that's statistically unlikely, and you just intuitively think that if there weren't an inherent relationship, then how could you produce this perfect line that the price would track? So I think that a lot of it comes from that people don't understand what regressions do, that they are retroactive tools to create these curve fits. So that, I think that's one part of it. And the other part of it is probably just intellectual laziness, that you don't want to really understand how markets work. You just want a quick story that, like, okay, I don't know anything about this space, but this stuff has math associated with it. These guys seem smart. I'm just gonna pick this model, and I'm gonna hope that it's right. I mean, we gotta understand that most people aren't like us. They aren't working full time with crypto. It's just something that comes across their feed, and they spend maybe an hour here and there, and they don't have time to become like deep, wise sages that understands the true nature of the markets, and they just latch onto something that has a lot of momentum, like backing from other smart people, and they just think, okay, well, if I'm right about this, then I'll make 10x my money, and that becomes a beautiful story to them, and they want to believe that story, and they start to follow these people that tell these very elegant and beautiful stories around how they're going to get rich. So it's a very compelling narrative to believe. So I can completely, I mean, if I was able to look at Aesop's models that were completely, like, compared to Plan B's, his writing, I mean, Aesop's was basically, it was dog shit compared to what Plan B produces in terms of how eloquently the arguments are articulated and how much data is behind the models. So I think when I was new, when I looked at the first the primitive forms of the rainbow chart, and I thought, maybe it's going to keep going in that trajectory. If I can make that, and I consider myself to be a reasonably intelligent person, if I can make that leap of thinking, then I'm not surprised at all that the other people in the space are so easily swayed by the rainbow model and the stock to flow model.
Yeah, I think it's just that perfect combination of these people appear to be smart, or at least smarter than you are, right? If you're someone who's not an expert or remotely interested. They are key figureheads within your industry, so that kind of adds an air of authority or gravitas. And then perhaps most importantly, the conclusion to which the model and its assumptions arrives at is one that's favorable to you and your personal outcome, and your most importantly, your pre-existing investments. Right? I don't know many cases of people investing into Bitcoin because of stock to flow, but certainly the validation effect that it has on those who are already invested, it's about sort of converting the converted at that point. And obviously the memes, colors, that sort of virality of it, I just think it's the perfect storm. And despite, seemingly what would otherwise be fatal blows to the methodology, I think just the fact that it's so inaccessible to most, but the conclusion is so pleasant, it'll live on, I'm sure, in many other forms and models as well.
Exactly. And hey, I mean, saying that the price of Bitcoin is going to increase in the future is not that bad of a bet. I mean, the rainbow chart or the stock to flow model will probably be roughly correct, because they just say the price is going to increase in the future. And even if you make a fundamental based analysis, which is what I do, and how I think about the Bitcoin price, then you reach a sort of similar conclusion. So they are not bad models if you just take them as price projections. Of course, the methodology and the science behind them are completely rubbish. But if you ask me how I genuinely think that the price of Bitcoin is going to develop in 2021, the rainbow chart is a pretty good chart for that. It's the price. I would personally think that if we're in the blue zone of the rainbow, then I would think that that's a fire sale, and you should definitely buy a lot of Bitcoin in the blue zone of the rainbow chart. And if we're in the red zone of the rainbow chart, then I would not think that Bitcoin is particularly cheap. And you could, if you needed your money for some reason, you wanted to take it out, the red zone might be decent spot as any to take your money out. So that's the ironic thing with these models, is that they do kind of also. They're not bad projections, and they might hold up. I think maybe both the rainbow chart and the stock to flow model could hold up for another couple of years.
There you go, the headlines now. Eric Wall doubles down on rainbow chart projections. Thing is, it's funny, it's reminiscent of almost kind of bad trading, especially when you're a beginner, whereby the outcome might be great, but your process is terrible. But because the outcome is great, you can always afford to look past the process until, of course, it catches up to you and bites you in the butt. You mentioned, or you alluded to, kind of the future and how you sort of view Bitcoin. So I was privy to an interesting discussion you had with John Paul Koenig, one among many, I'm sure you recall. And it's this kind of two-part write-up. The first, I'll link the tweet in the description or the show notes, but it's just kind of where are we going anyway, and then so what is Bitcoin's end target? And it's a very interesting kind of write-up, and you kind of start, correct me if I'm wrong, of course, with my summary, but it starts with an outline of how a lot of other people think about Bitcoin's future price by analogizing to gold in one form or another and making deductions based on gold's market cap. But then you go further with the argument and essentially make the case that because Bitcoin's moneyness is superior to that of gold and its digital native properties, etc., that perhaps using gold as the benchmark is conservative, which may sound crazy at current prices, but that's sort of the, if I've understood correctly, the chronology of arguments made within that blog post. Do you want to give, first of all, is that correct? Second of all, could you give us a rough outline on how, like, high-level overview of how you do view Bitcoin price, its developments, and whether gold or money generally is useful for as a benchmark?
Yeah, no, I think you roughly hit the nail on its head with your description there. And I mean, when I started to do fundamental analysis on Bitcoin, you're kind of looking so how you apply the fundamental analysis is you're kind of looking for other things in the realm of assets that you could compare Bitcoin to, and then gold is of course the most readily available one that resembles Bitcoin the most, because it also gets the majority of its value from its just a property that it's very difficult to inflate the supply of gold. So the stock to flow ratio of gold and Bitcoin are quite similar. So that puts Bitcoin in that type of category of assets. So I think that gold is a great starting point for Bitcoin. If we're thinking about investors globally, and we think about what role does gold play in these investors' portfolios, then I mean gold is a hedge type of asset when there's a lot of political global uncertainty, or when you're unsure about inflation or what's going to happen in the financial markets. Then gold is always a safe bet, because that's just an asset that does nothing, that has very little external events that can influence or disrupt its price. So when you have an asset that's completely disconnected from almost everything else, then that asset's value will grow at the rate of GDP of society. And to break that down a little bit, what I basically mean is that if society can produce with the current technology, if we can produce 10 gallons of milk at a given year, then there will be an exchange rate between a gallon of milk and gold. And then if society next year can produce 10,000 gallons of milk because the technology got better, then the price of milk is going to go down a lot in relation to gold, because gold is not changing. So that means that as society becomes more advanced and the technology improves, it actually makes gold more valuable, because you can now buy more things with it, because things are now cheaper to produce. So gold is a good investment in that sense, that you can just put your money in gold, and because it's static, then it will also grow in value. It won't just conserve your money; it will actually grow in value, because society gets better at producing things. But gold is still, I don't think that people fully appreciate how niche gold is. I mean, anybody that's listening to this, you can ask your parents, like, how do you invest your assets, and how do their friends invest their assets? And most people don't own gold. Only about 17% of Americans have any exposure to gold at all, except for maybe you have a small gold necklace or something like that. But most people do not treat gold as an investment class. Most people invest in the stock market, or they buy real estate. That's what most people do. So gold is not mainstream. Gold is a niche asset, and I think the reason that gold is such a niche asset is that it failed. It failed as a monetary tool, because just fiat money was so much better at being the medium of exchange in society. So gold fell out of society, both because the U.S. government basically cut the ties between the money and the gold, of course, which happened in 1971 with the end of the Bretton Woods system. So of course there's governmental reasons to why gold has been pushed out of the purview of mainstream economics so much, but gold plays a very niche role in the economy today, and there is no reason. I mean, the reason why gold is not successful as money today is because that's not something that you could reliably run international commerce on. You couldn't make gold-based transactions. I mean, there has been attempts to internetify gold so that you could trade with small pieces of gold over the internet. eGold did that when the internet was new. But I just wrote a tweet about this, how that project, Bitcoin does almost 20,000 times the volumes that eGold did, even when eGold was at its peak. So Bitcoin is already 20,000 times more successful than eGold ever was at transferring value across the internet. So I think that we can definitely see, like, Bitcoin is going to become a successful medium of exchange in an internet-based world, and gold is going to remain this niche store of value asset that can only be used for that, while Bitcoin is going to be used to settle debts between friends, among companies, among institutions, among countries. So I think that just thinking about Bitcoin about Bitcoin as something that could compete with gold, you're really constraining your view of what the future for Bitcoin might be. Like, let's say that Bitcoin actually becomes as large as gold. do you think that you wouldn't see countries, companies, institutions that would actually use that asset to settle debts? Because I mean, it's an internet-based asset, right? The whole system is designed so that in order to make it so easy for you as possible to send value using it. That's what the whole asset is designed to do. And so it's not going to stay just as a store of value asset, because then there are going to be tons of economies, tons of people in different countries with very poor currencies that are just going to prefer to transact wealth in that. I mean, if they're using that to store their wealth, why wouldn't they? If they need to transfer a piece of wealth to somebody else, why would they have to go out of Bitcoin and into something else to transfer their wealth when they can just stay in Bitcoin and transfer it that way? And if that's how Bitcoin develops, that people actually start to use it as a wealth transfer mechanism, then we have captured a much larger market than what gold is used for today. So then in that blog post, I start to reason about, okay, so if Bitcoin becomes a digital gold, it will probably start heading towards becoming a universal type of money. And what would the market cap of a universal hard money be? And I can lay out the arguments for why I put that around $200 trillion is where I put the valuation for that. And that comes from, you look at the monetary premiums in other asset classes, stocks, real estate, bonds, those asset classes are in the range of hundreds of trillions of dollars. And that's the type of market that Bitcoin would realistically compete for. It wouldn't be this $10 trillion that gold has if Bitcoin actually becomes successful as a transfer mechanism of wealth.
What do you think stands in the way of that?
Two things. The first one is regulation, of course. This is something that, I mean, if this happens, this is going to erode. It's going to erode the power of the nation state. It's going to erode the ability for nation states to print their own money and wage endless wars against each other and manipulate the import and export rates versus each other, and basically use their currencies as war tools against each other, and also as mechanisms to siphon wealth from their own population, which is what gives the state its power. So Bitcoin is the most powerful device ever contrived to take power away from the state. So the states are, I mean, either they're going to just fall down and allow themselves to get overthrown by this decentralized protocol, or they're going to fight it with nail and tooth. And I think that we're probably going to see a bit of both. There are going to be some governments that are going to fight Bitcoin. There are going to be other governments that are going to see an opportunity if that happens and say, okay, well, if these governments are trying to lock their populations out of the Bitcoin system, then we can actually perhaps get a monetary advantage versus those countries by being very positive to Bitcoin. So I think that we'll see this is going to go on for a number of decades, where countries are going to have to choose their stance versus Bitcoin. Some will be against, some will be for, and it won't be until Bitcoin has sort of won that international political struggle that we'll see how large how large of a role Bitcoin will play in the economy. And I think that $200 trillion, that's the successful outcome. There's definitely a possibility that Bitcoin only becomes, half successful at that goal. So it could be, within the range of $20 to $60 trillion and sort of be semi-successful in doing that.
Yeah, I think the gold argument is very interesting because it's inoffensive, right? If Bitcoin beats gold at gold's game and becomes a store of value, it doesn't castrate the state in such an extreme capacity or to the extent that it would if it became this kind of global, almost kind of Keynes's Bancor type of money, right?
Mm-hmm.
I think that's why a lot of the analogies are made to gold, because then you don't have to wrestle with the difficult implications of it traveling beyond that. On that topic, I want to kind of get a perspective of time from you. One of the arguments that we've seen, I mean, Suzu of Three Arrows Capital, and there's other, other thinkers in a similar realm. The argument essentially is that this is going to take place, at the very least, the stage one, if you will, Bitcoin to gold move. It's going to take place in the form of one cycle, or a super cycle, as it's called, which will also be the final cycle for Bitcoin as it kind of reaches critical mass almost as far as store of value goes. Do you subscribe to that? Do you believe this is the notion of a super cycle? Does that eliminate shorter term market cycles, or just any type of chronology of time would be super cool to hear from you?
Yeah, I think that Bitcoin has a reasonably strong chance of coming into parity with gold's market cap within the next 5 years. And, I wouldn't say that that's necessarily going to happen in one single move up. I think that we could definitely have a bubble that reaches a climax point and pops this year at, let's say, 150,000 or 180,000 or 200,000 or just $100,000, somewhere around that, and sort of top out. And then we go into a new expansion a couple of years down the road, and then Bitcoin goes to $400,000 or $500,000 and actually dethrones gold. So I think that that's definitely possible, that we'll see two of these pops. But I don't think that it's. I do think that we have a lot of, like, the macroeconomic situation is at such an extreme point now that we may just skip that bubble pop that we usually see in Bitcoin and just continue with Bitcoin just aggressively continuing its takeover. So I think that those people that subscribe to the one super cycle theory, they could definitely be onto something, but it's not necessarily that's exactly how it's going to play out. It might take two cycles to get us there as well.
What do you think are the altcoins going to do if that were to happen? Are there any altcoins that you like? Is there anything in the space that interests you?
Yeah, so you asked me previously, like, what are the things that I think stands in the way of Bitcoin is succeeding at this, and I said two things, and we only talked about the first thing, which was regulation, and the second thing is, of course, that Bitcoin gets outcompeted. I mean, I don't eliminate that possibility. I think that the cards are currently in Bitcoin's favor. Bitcoin has a very it's made a lot of progress that the altcoins will have to play a long catch-up game before they can get where Bitcoin is today in terms of how mainstream economists, macroeconomic analysts, and companies, corporations, and just people all over the world, they now view Bitcoin as something real. I think that it's very far off for any altcoin to be near as successful at the mimetic game that Bitcoin has played in the previous decade. So I think that Bitcoin has a tremendous lead, and I think that it's if I'm betting my money on something, then I'd probably bet it on Bitcoin. But that doesn't mean that there aren't EV bets, like risk reward bets, that you can make outside of Bitcoin that are also favorable. It's just that they are further out on the risk curve, and they give you a potentially a higher return for a higher risk. And in some cases, those risks are low enough that the rewards are worth them. So I think that Ethereum is probably one such project that I do think that the risk reward of that project is, I mean, it's definitely further out on the risk curve, and it also plays a sort of complementary role to Bitcoin. They're not mutually exclusive, these projects. I mean, the DeFi space of Ethereum and then the store value narrative of Bitcoin are sort of complementary stories. So I think that both Bitcoin and Ethereum can have value, and that immediately makes it so that all these, I think that the competition that Bitcoin sees from other coins, there's really not that. The only project that really threatens Bitcoin today is, well, that would if the Ethereum platform and DeFi becomes super successful and becomes a huge story, and then the ESG narratives around Bitcoin's energy footprint versus Ethereum's proof of stake based energy footprint, if we leap a few years into the future and imagine that proof of stake is now implemented in Ethereum, then I think that Ethereum, it has a chance to be viewed as something that could, like let's say something bad happens to Bitcoin, then Ethereum is very it stands ready to take the role of where Bitcoin has been. But I do think that just the idea of Bitcoin failing is not something that's good for the cryptocurrency space overall, because I think we've been able to create this story that we have created a digital form of gold, but gold was gold for thousands of years. It didn't lose its status because a new precious metal came along and was better at being gold than gold was. Gold was always the better one of the precious metals to store value in, and that was proven over thousands of years. And I think if Bitcoin just makes it 10 years and then it fails, then that's going to diminish the narrative around cryptocurrencies. I don't think that that's a future that we should hope for, but I don't think it completely eviscerates or eliminates the. I mean, some people it might take 5 years, and then the cryptocurrency market recovers again, and then there'll be a dominant player, a proof of stake based dominant asset, and people will say, oh well, Bitcoin was the first prototype, and now we got this other asset that is also the supply is also constrained, not as constrained in the same way as Bitcoin was, but it is still more constrained than fiat currency is. So it's still better to have this thing power the economy than fiat currency. So I do think that the altcoins both play a complementary role. Basically, the only altcoins that I am interested in right now are smart contract platforms. So it's Ethereum and the Ethereum killers. That's the coins that I'm tracking in the altcoin space. Then, of course, DeFi coins. Also, I also pay some interest to those coins because they are the breadwinners of the previous year, and there's also all sorts of ways that you can generate alpha by trading DeFi coins. However, I think that perhaps the risk reward of DeFi coins aren't as good as in Bitcoin and Ethereum still, even at these valuations, because I mean, just take Uni as an example. I mean, that's definitely a security, yet it's listed on all the exchanges when its regulatory status is it's probably a security. So and Bitcoin and Ethereum doesn't have that. I mean, they have already gone through the SEC's hands a number of times, and they decided that these assets are not securities. But most DeFi coins are probably securities, and their valuations, I mean, they're not that low if you consider the fact that how many of these different DeFi coins there are so many different lending protocols, there are so many different DEX systems, there are so many different and you don't know which one of these will actually become successful. So if you take that into account, then I think that the DeFi token valuations aren't like super attractive, whereas in Bitcoin's case, I can still say that Bitcoin is on the path of becoming a multi-trillion-dollar asset, and right now it's just valued 1 trillion. So I can say with good reason that Bitcoin is, you know, undervalued relative to what it could become in the future. I'm not sure that I could make the same argument for DeFi coins, but what you do have in the DeFi coins market is extreme speculation going on right now. So there's of course money that you can make there, but I wouldn't make my DeFi exposure more than, let's say, 10% of my portfolio, because I mean I'm still pretty conservative with my strategy in the market, and if I know that there are some bets where I can have high conviction and a relatively good return, then I'll pick that for the majority of my assets, and I'll use maybe 10% for these short-term opportunistic trading strategies that you can make in the DeFi space. But outside DeFi coins, I basically only think about smart contract platforms. I used to think about privacy coins, but I don't anymore, because smart contract platforms can emulate the properties of a privacy coin pretty well. I mean, the zero knowledge proofs, a smart contract platform can validate the same type of zero knowledge proof logic that powers Zcash cryptocurrency, and that can make any smart contract coin can reach a higher privacy degree than Monero or any of these other privacy coins. And the network effect of an ecosystem that captures the DeFi, all the DeFi activity, is going to create much stronger network effects than just a single illiquid privacy coin can ever do. So yeah, the things that I care about are basically Bitcoin, smart contract platforms, and a little bit of DeFi dabbling, basically. And in Bitcoin, there's really not that much to do. You just buy and hold Bitcoin. But the smart contract space, that's where I think is probably where I spend most of my time and digging and thinking, because Ethereum's position in the smart contract competition is much less clear than Bitcoin's role in the store of value category is. And there's a lot of ways that you can use your insights about technology in the smart contract competition, where you can actually generate alpha for yourself by knowing, okay, so this smart contract platform actually has legs and this one does not. So that's the way that's what drains most of my attention these days, is understanding the different scalability challenges and different philosophical trade-offs that different smart contract platform does. So assets that I have been trading in just these last couple of months has been, well, of course, the Ethereum and the BTC pair, the ETH BTC pair, but also Avalanche is interesting to trade. Solana is interesting to trade. Near is interesting to trade. Polkadot is interesting to trade. And Binance Coin is probably one of the best trades that I've done recently. Is when in beginning of February I noticed that some of the DeFi activity was genuinely leaking out of the Ethereum ecosystem for the first time, and it seemed like the Binance Smart Chain was the first platform where that activity was seeing some organic uptake. So that's created a very good trading opportunity. So it's those kinds of trades where I see, well, where I can personally insert my own type of knowledge and make profitable trades.
Does that suggest that Ethereum's kind of network effects or first mover's advantage, however you want to classify its current status, it's a lot more fragile, right? Because even just using a basic example, if you were to say Bitcoin killer, that would be interpreted with immediate skepticism, if not laughter, right? At least in the current landscape. Whereas if you say Ethereum killer, suddenly you've got a bunch of very reasonable investment theses. As you mentioned, in recent times, it's been playing out with other chains capturing some of that economic activity when a large group or portion of participants get priced out due to fees. Is that a fair kind of assertion to make, that maybe Ethereum's advantages are more fleeting?
Yeah, and I'll just pretext by saying that I'm among Ethereum is by far my largest holding among the smart contract platforms, and I do think that Ethereum has the strongest likelihood to be successful in the smart contract platform world. But there are definitely trading opportunities there, because it's pretty similar, the situation to what happened to Bitcoin in 2017, when the fees in Bitcoin for the first time made it looked like Bitcoin wasn't going to work out. For the retail people that came into the cryptocurrency space, they just saw that, I can't afford to make a transaction on Bitcoin, and then everybody told them, oh, well, that's because Bitcoin is antiquated technology and there's these other coins that you can use. I think that Ethereum is in that same situation now, where people will be bullish on DeFi, and then they'll notice that they don't have enough money to make to be a regular user of Ethereum, and that creates opportunity in all these other smart contract platforms. I do think that the rollups that are being developed on Ethereum today is the most interesting, or sort of the most sound way to scale a smart contract platform. So I think that Ethereum is doing the right things. I'm not that big of a fan of the sharding roadmap that's on the ETH2 roadmap, but I think that rollups, and it might be the case that Ethereum just does rollups and then sharding just never happens. I think that there's a lot of pressure on the Ethereum team to deliver sharding just because they've talked about it for so long. But I don't think that technically that sharding needs to happen. I think that what we should do first is just focus on rollups. And I think that maybe Vitalik has a blog post about this where it's called a rollup centric roadmap for Ethereum. So I think that he fully understands that, and he's trying, and he probably put that article out to just see if people can prefer that path instead of sharding. I know that sharding is still being worked on. I do hope that we'll try just to scale Ethereum using rollups for a while before we take the nuclear option and go with the sharding roadmap. But I mean, rollups are migrating the activity into rollups. It's equally hard and perhaps even harder than just migrating them to another chain. So that's what's creating this trading opportunity now, that while Ethereum is trying to scale the system in this very complex way, there are people offering quick fixes. And there could be, I would prefer if everyone just focused around making rollups as good as possible and just stayed centered around the Ethereum ecosystem. I think that would be the best path for everybody. But at the same time, I got to consider how can this actually play out in the market. And I don't eliminate the possibility at all that things don't go the way that I want them to. And there is some platform that just relies very heavily on marketing and thus trade-offs in terms of scalability and decentralization on the back end, and just comes out and everybody thinks that platform has solved all the problems that Ethereum was struggling to solve, and then that captures a lot of the DeFi activity, and then that DeFi activity actually stays there on that platform. That's not like my positive outcome, but that can happen, and I think that other people also see that as a possibility, and that's why these other Ethereum killer platform has been the best performing coins in the last 3 months.
Yeah, I think in general with the scaling argument, it's always like you get problems scaling. Bitcoin did in 2017, something else comes up, and then something pulls back. Like, I mean, ETH's not been performing as well, and then it gets worked on, and a couple months to years later, it just comes back up again, and it's better now, but just a little bit, and then that just happens over and over again as everything just kind of moves forward, right? Do you think at any kind of stage we're gonna get past the scaling issue at like completely, or is it always gonna be a roadblock, and it's always gonna be that like moment where everything just takes a step back and maybe we get pulled back or something?
Yeah, I think if for smart contract platforms and for Bitcoin, the situations are pretty different, because one of the things that are driving the very high fees in the Ethereum ecosystem is that there are these on-chain arbitrage opportunities. You don't really have that in Bitcoin, that there's a transaction that you can make in the Bitcoin blockchain that will make you rich. But there are the Ethereum chain is swarmed with such opportunities at any given moment. There are tons of arbitrage opportunities inside the protocol itself all the time. And those types of transactions will crowd out all the like users that just wants to transact. They don't want to pay more than a few bucks. But a person who wants to act on an arbitrage opportunity, he can pay, whatever the arbitrage is worth, and then minus the transaction cost. If that's still if that's still revenue for him, then he will still pay that price. So I think that what you need in a smart contract platform is you inherently need different silos of fee environments. So you'll need one environment where if you just want to make payments, then that will have to be in its own mempool, and the fees will have to be isolated to that specific use case. Whereas, so I don't think that if you have arbitragers that make DeFi transactions and they make arbitrage trades on decentralized exchanges, you cannot have those users compete for the same block space as the ones that are just doing payments. That's why I think rollups are such an elegant solution, because that allows you to have, for instance, one rollup that just does, let's say, anonymous payments, and then you have another rollup that does decentralized exchange trading or margin trading and leverage trading. And I do think you'll need to separate that if you want to have a low fee environment that's scalable in the long term. And right now you have these Ethereum competitors where they basically have no fees, and the only thing that means is that there's not that many traders doing decentralized finance arbitrage trades in those ecosystems yet. But even if you have a chain and it's provides 10 times as much block space, as much throughput as Ethereum, that only means that you now have space for 10 times as much decentralized exchange activity. And I used to work previously at a company. We built matching engines for the we built, for instance, the London Metal Exchange, the Australian Securities Exchange. We built the technology for those platforms, and it's not like if we made the engine go 2 times faster, that would mean that we had tons of room for transact, like we had a lot of space over, because traders, if you give them more, it's like bandwidth. It's like the internet. Like if you give people more bandwidth, it just means that they're going to be streaming YouTube videos when they're on the toilet. And it's the same thing with trading and arbitrage opportunities. If you give people more access to deploying smart contracts and creating trading products and derivatives, it's just it's always the usage is always going to use up all the available space. So you cannot. It doesn't matter how much throughput you give a system, you are going to need to create these siloed fee environments in order to create different fee pressures in different silos. That's the only way that you're going to be able to do it. And I think that that's exactly what Ethereum is doing, both with rollups, both with sharding, and that's the only way forward out of this maze. But what can happen is that people don't realize what I'm realizing right now, and they think that these other platforms has solved the problem that Ethereum hasn't been able to solve, just because you start over afresh on a new chain. It doesn't have as much state bloat. It has no history, and most of those smart contract platforms make trade-offs in terms of the decentralization versus the throughput, so they do go faster. So they will seem to a lot of people, these systems might seem as they have an advantage over Ethereum, and that might be enough for Ethereum to get dethroned in the short term. And then once you have a network effect in another system, then if Ethereum wants to get back in the game, now it has to compete with this other platform's network effect that maybe it got illegitimately just by people being stupid. But network effects can be created by people just being stupid. It doesn't matter what's right or wrong. It's just how the market and the ecosystems evolve.
This is by no means an elegant question. But in somewhat relative terms, like you've addressed rollups and sharding as remedies potentially for scaling issues. How about monetary policy changes that we're seeing in ETH? Like the most recent one that's been on the headlines is the EIP 1559, and then generally the transition from proof of work to proof of stake. Do these help scaling? And if so, is it possible to almost kind of compare them in terms of their relative impact or magnitude to the technological advancements that you mentioned earlier?
Yeah, no, so they don't address scaling, but they do address other things. So EIP 1559, for instance, harmonizes fee fluctuations, so that creates a better user experience. And the monetary policy which Ethereum has, which is the minimum viable issuance, that means that the protocol will always issue enough block rewards to make it profitable to be a validator in the system. That has an advantage in the sense that it's easier to say that this system will provide security for its transactions in the future. So I think that monetary policy can be used to create a better user experience. It can be used to create more reliable security. You can even EIP 1559 that also has a part of the portion of the fees that get burned can even create instead of Bitcoin, which just has a fixed cap, Ethereum can have a deflating supply, so it can actually have a negative emission, so that the total supply actually shrinks. So those three things, better user experience, more reliable security, and the deflating supply, those are three very, very strong narratives, I think, that Ethereum users will probably rely heavily on. So what they don't have is that they don't have this super clear meme that Bitcoin has, that there will only be 21 million coins and that will be it, and that's something that resonates a lot with people. But they'll have these three other things, and they will intelligently employ those arguments to undermine the premise that Bitcoin delivers by saying, okay, well, Bitcoin gives you this, but we give you this instead. And I think for someone that is trying to compete with Bitcoin, Ethereum is already competing with Bitcoin intelligently. Well, perhaps not intelligently, but at least strategically in being a green cryptocurrency that doesn't have an energy footprint. And then it can also compete with Bitcoin by having a completely different fundamental philosophy around how it gets security, how it provides a good user experience, and it can even start to compete with Bitcoin in terms of the ultimate scarcity by saying we have a deflating supply. So I think that those the EIP 1559, the proof of stake, those things are going to just cement Ethereum's role as a very different project with different assurances and different advantages to Bitcoin in a very clear way. And that might be a reason that, Ethereum is going to persist for a long time alongside Bitcoin. And if something were to happen to Bitcoin that made Bitcoin fail, Ethereum wouldn't necessarily need to fail for the same reasons.
Yeah, those implications are certainly much more significant than I had first envisioned. I mean, I've learned a lot, Don. I'm sure you have as well. And Eric, of course, you've been incredibly generous with your time. I want to give you the opportunity to either leave us with any final thoughts, or where can people read your work? Anything you want to leave our audience with generally?
I always get this question, but I never really have anything particular to say. I mean, just follow me on Twitter. ERCWL is what my Twitter name is. And if you have anything of relevance to the conversation that we've just had, feel free to plug me there. I do find it more troubling these days to get through everything that's in my inbox, but I do some type of filtering there. If somebody has something really interesting to say, I do make time for that person. But it is, I mean, I'm sure you guys suffer the same experience, that you want to answer everybody, but you can't. You would sit and answer people in your inbox for 24 hours a day.
Absolutely.
It just doesn't work. It's very sad, because I do want to get back to everybody that reaches out to me, but it's just impossible sometimes.
Hopefully we don't burden you too much. Don, any final notes?
No, thank you for your time. Really appreciate it.
Yeah, thanks, guys.
It's been a pleasure, Eric. And a final that's all from us at Technical Roundup. Thank you once again to Blockfolio for sponsoring the show, blockfolio.com or blockfolio.trade for more information there. Eric, thank you one final time, and we will see you all for the next episode. Take care.
Cheers.